Good morning, listeners, and welcome along to the final in our webcast series of Deep Dive Advisor broadcasts. My name's Mark Stubbings and I've got the pleasure of being your host today. And let me just recap briefly on what we're doing. Obviously in these tumultuous times it's pretty important to be open and honest about your assets, how they're performing. So we've come up with this webcast series to quite literally deep dive into our various asset classes, to talk about their performance, the construction, how the decisions are made regarding the composition, etc. Today we're actually talking about our listed asset class, which is a little bit different to our previous webcast, but shortly I'll introduce our speaker for the day, and the speaker today is Greg Barnes, and I'll give a proper introduction shortly. Prior to this one, as mentioned, we've actually focused on the unlisted asset classes, and if you go to our website under the tab Advisor Webcasts, what you'll see is a number of webcasts based on our unlisted assets, and we've touched on things like property, infrastructure, alternative strategies and our private capital. As mentioned today, we're looking at our equities option, our listed assets. So what you can expect today, I'll introduce Greg Barnes shortly, but Greg is actually going to take us through a foundation style presentation, and what he will do is he'll talk about some important parts which will underpin obviously the questions. What we'll do after Greg's presentation is we'll actually deal with some questions we've already received, and we have received a number. So Greg's obviously had the benefit of being able to prepare for those, and he has some answers already. We'll then pass over to our live webcast. Live questions on our webcast. Just in terms of legal responsibilities, we have a disclaimer to address. Obviously today is general information, and it's not designed to look at any person's specific circumstances or individual goals. Let me now introduce Greg Barnes, our speaker today. Greg is obviously the manager of our listed assets, and he joined Sunsuper in 2014 after 30 years looking after portfolios, aligned portfolios. And you sort of think, yeah, he's probably got a pretty good handle on that. Greg has had some fairly senior roles with AMP and RHB, and also interestingly when he started his career he was actually a geologist, an exploration geologist looking for oil gas, and we had an interesting chat a wee bit earlier. From an academic point of view, Greg has a Bachelor of Science and an MBA. So ladies and gentlemen, just to discuss the foundation presentation, let me pass over to Greg Barnes.
Thanks very much, Mark, and good morning, everybody. If you look at the first slide there, you can see that the listed shares asset class has around $32.5 billion invested in it, and it makes up the major proportion of our portfolios. So as much as 2/3 of the major diversified options. And in addition to that, we have a number of single asset class options which comprise 100% of shares or equities. I'm sure that most of you are familiar with equities. It's the principal growth asset that we have in our portfolios, and it generates returns through both the capital appreciation, so the share price is going up, but also it pays dividends, and those dividends certainly in Australia attach franking credits, which are also a benefit to our members. But it's a very risky asset class. It experiences high volatility, but over the long term it generates the highest return. And we only need to reflect on the experience that we've had over the last 12 months to really appreciate that fully. We use the broadest benchmarks in our portfolio. We really want to give our portfolios exposure to the widest returns possible in listed shares. And we think about it in two key segments, so Australian shares, so shares listed on the Australian Stock Exchange, and then international shares. And we split that down into both developed markets and emerging markets. And then importantly, all of our listed shares are held in segregated mandates. And that's important because those securities, unlike a fund or a fund structure, do not leave the Sunsuper vault. So we have total control over those assets at all times, which adds some interesting advantages to us in terms of our ability to lend stock and sweat those assets over time. Then turning to our investment approach, we use an external manager model that really allows us to access the best managers globally. We focus on manager selection and portfolio construction. They're the two key things that we think about. Identifying the best managers globally and then bringing them into our portfolio in a way that delivers our portfolio objectives. So the two key things that we focus on a day-to-day basis, manager selection and portfolio construction. Our goal is to create a really efficient and scalable investment approach, one that stood us in good stead as we've doubled our AUM from around 30 to close to 70 billion today. And going forward, we expect to see that to double again. So we really want to ensure that we've got something that works today and will work tomorrow. Our strategy is really to maximise after-tax alpha for the fees spent and the risks we take. That's the little equation that we're looking to solve on a daily basis. And importantly, we're really trying to create a broadly diversified portfolio that doesn't have exposure to any one particular risk factor. So any one style factor or any one geographic factor. Really what we want to see is the stock selection skill of our active managers coming through into our portfolio. So if we go on to the next slide, this really shows our strategy on a page. I won't go through this in detail, but a couple of key highlights. As investors in equity markets, we get paid for taking risks. So what are the key risks that we can take? We can take market risk or beta risk. We can invest in common factors, so think geography, think industries, or even style factors, so value, growth, momentum, and so on. And it's quite easy to access those factors. And because that skill is not that rare, it's also very cheap. So we try and save money by investing in those key styles or those key approaches, and then saving a little bit of money to invest in fully active or idiosyncratic managers. So these managers are the ones that are very much focused on picking stocks, making significant bets in their portfolio, deviating away from the index. But finding managers that are really skilled in that space is difficult. So think that that skill is very scarce and therefore very expensive. So we don't have a lot of it in our portfolio. And that's really the framework that we use on a day-to-day basis. So if we turn to the next slide, this starts to explore the portfolio in a little bit more detail. So what we're showing here are each of those big style buckets, so passive, idiosyncratic, and fully active or managers, and then the managers that we have in each of those different sleeves. So we're trying to identify the best managers globally. We don't want to have too many, but we want to have enough to give us diversification in each one of those portfolios. So diversification along different style lines, and avoiding high correlation in those portfolios. So if we look at the Australian active managers, a lot of these will be familiar names. So Maple Brown Abbott, a great value manager. We've had a relationship with them for over 20 years. Then, as I said before, each one of those managers we have a discrete mandate with. So that means that we can tailor that mandate so that it meets our individual needs and requirements. And then, as I said before, those shares really don't leave our vault. And that's important when we think about things like tax management and particularly investing in some of the off-market buybacks. And that can add significant value to the portfolio. And it also allows us to include various exclusions and other ESG considerations into that portfolio. And then you'll notice that Vanguard, the passive component, comprises a reasonably large chunk of each of our portfolios. So that gives us the beta exposure or the market exposure in the portfolio. And because of the scale of our relationship with Vanguard, we're able to achieve that at very, very low costs. The only other point I'll make about this slide is that the way we've structured each one of these portfolios, Australian equity, developed markets, and emerging markets, is in a modular way, so that we can mix and match each of those different slices to create various products along the way, not only for our big diversified portfolios, but also for our segregated single asset class options. So think of our passive equity mandate where we just use the Vanguard portfolio to provide that. If we go on then to the next slide, we really think about who are the best managers that we can access. And this slide just sets out a couple of examples. So Baillie Gifford is a high growth manager. They're based in Edinburgh in the UK. They manage a portfolio in our developed markets asset class. These guys are really trying to identify using deep research, using a team of very skilled analysts and portfolio managers. They're looking to identify companies that have a long growth horizon. So they think 10 years into the future, how big can these companies really get? Not necessarily concerned that much about value, but thinking more about growth. So it's not surprising that the portfolio that they develop includes names like Amazon, Alphabet or the former Google, Tesla, the electric car company, and some of the Chinese tech giants. So think of Alibaba. But their portfolio is highly concentrated. They pick those stocks, they want to hold them for a long-term time and minimise turnover. Bozena, on the other hand, is a deep value manager. They're based in New York, and they run two mandates for us, one in our developed market portfolio, one in our emerging market portfolio. That's important because we get a big scale benefit by doing that. So Bozena's approach is really to identify companies that are relatively cheap, undervalued companies in the market. They use deep research to identify those companies. They spend a lot of time analysing them. They might be out of favour with the market, but based on their research, they think they're good value. And over time, the market will reflect that value in rising share prices. So when we look at the Bozena portfolio, we see names like General Electric, Honda, Lenovo, which is the company that bought the IBM laptop and peripheral business a number of years ago, and Samsung, one of the biggest chip and electronic device manufacturers globally. Again, a low turnover, quite concentrated portfolio, but they spend a lot of time thinking about diversification because of the risks in investing in deep value stocks. Then lastly, Vanguard. So as I mentioned before, Vanguard manage our passive portfolios across all of the three sleeves that we have. They have a global presence, but they have a very strong representation in Melbourne here in Australia. It's where they have their Asia Pacific headquarters. Vanguard manage discrete portfolios in each of those sleeves. They use a full index replication model. So that means they hold all of the stocks, or nearly all of the stocks in the portfolio. And they're able to leverage their tremendous scale globally to drive very low costs. So it's not only a key part of their process, but it's also a key part of their organisational culture and philosophy. And we benefit from that. Importantly, because we have discrete mandates with them, so these are tailor-made mandates with them, we can ensure flexibility in those portfolios. And as I mentioned before, it allows us to really maximise the tax benefits from that portfolio, which we're able to pass on to our members in fully after-tax returns. So if we go on to the next slide, this looks at the portfolio, each of the different asset classes based on active sector exposure. So what is the portfolio's exposure to each one of these industry segments compared to the benchmark? So are we overweight a sector or are we underweight a sector? So in each of those three panels, we have the three different asset classes. So on the left, we have Australian equity. We can see that it's a portfolio that's overweight materials and energy. So our managers in their stock selection in the portfolios that they're managing for us are tending to favour at the moment materials, energy and some consumer discretionary stocks. So think of this as a more cyclical portfolio. So they're expecting economic growth and recovery to continue based on those industry exposures. What are they underweight? They're underweight financials, so underweight the big banks. And that's been a common exposure in our portfolio for a number of years. Australian banks, as I'm sure many of you know, are amongst the most expensive globally. So our managers are underweight that sector, but also underweight healthcare. So think companies like CSL, which is very expensive. Developed markets, a similar sort of style. So our managers in their stock selection tend to be overweight consumer discretionary, materials, and also financials. So the global financials tend to be more cyclical stocks. So a very similar cyclical pattern in our developed market portfolio. They're underweight IT, and again, I'm sure many of you are aware that some of these IT companies are incredibly expensive, so they're tending not to hold as many of those in their portfolios, and also underweight consumer staple stocks. If we then look at our emerging market portfolio, which is in the right-hand panel, somewhat different. You can see that it is overweight technology stocks. So our managers in emerging market are able to find companies which they think are attractive in technology. I'll talk about this in a little bit more detail later on. But some of the stocks they hold tend to be more traditional tech names. So think of semiconductor manufacturers and semiconductor manufacturing equipment. But also some of the very large Chinese tech giants, which are incredible companies and not nearly as expensive as some of those US tech companies. If we go on to the next slide, this looks at our portfolios, our international portfolios in terms of their active geographic exposure. So the same concept, are we overweight or underweight a geographic region? If we look at the panel on our left, international equity, you can see down the bottom that we're underweight the US. Our managers in building the portfolio have tended to be underweight America just because of its incredible expensiveness, and overweight Asia ex-Japan, including some of the Chinese companies that are now listed on the US stock exchange, and also overweight Europe. So when you think about our developed market portfolio, I guess I always tend to think of it as underweight US, overweight Europe. Then if we look at our international equity portfolio our emerging market portfolio, on the right-hand side, we're overweight emerging Europe. So think peripheral European countries, but also Russia, the former Russian economy, and then also Turkey. And then, interestingly, we're underweight Latin America, so predominantly in Brazil, but also underweight China. So our managers, when they build their portfolios, tend to have less exposure to China in emerging markets. Then if we go to the next slide, the sort of companies that our managers are overweighting or underweighting in the portfolio tend to reflect their investment thinking. So typically thoroughly researched investment ideas which they put in their portfolios. And the way to read this chart is to think about it as our active exposure in the portfolio. So the deviation away from the benchmark. So we look at the Aussie market, you can see that, as I mentioned before, most of our managers are underweight Australian banks, so they tend to have less exposure to companies like CommBank and Westpac in their portfolio. Also, CSL, which is a very expensive stock, tends to figure less prominently in our portfolios at the moment. On the other hand, we're overweight Boral, which is a company that some of you may be aware is going through a change in leadership. Tremendous value in that company, which we think will be unlocked as that organisation restructures going forward. And then smaller companies like Healius, which our managers think is one of the better broader health service provider companies in Australia. In the international market, again, no surprises amongst some of the names there, Microsoft, Apple, but also some of the emerging new retail companies like Shopify. Some of the China giants, Tencent, which is one of the largest social media companies in China, and then also Illumina, which provides human DNA testing equipment, which is one of the leaders in that space and new medicine going forward. Then in emerging markets, again, I'm sure some of these brand names will be familiar to you. Samsung, TSMC, which is one of the largest manufacturers of semiconductors around the world. So TSMC produces the chips that go into cell phones, a massive range of products. And then some more traditional companies, POSCO, Korea's largest steel manufacturer and one of the lowest cost steel manufacturers globally. ICICI Bank, which is one of the leading consumer banks in India, and Lukoil, one of the largest producers of oil in Russia. And finally, just how have we performed? This chart looks at performance over the last 5 years or so. So the way to read these charts across the three panels for Australia, developed markets and emerging markets are that it's indexed to 100 around 5 years ago. So we've represented each of the key style sleeves in those portfolios. The yellow line is our passive sleeve. The purple line is our systematic or quant sleeve. And then the dashed line is the fully active managers. And then this just represents the excess return that each one of those sleeves are producing. So how much alpha are we getting from each one of those strategies? Just a couple of things to highlight there. We can see that in pretty much each one of the asset classes, so Aussie shares, developed and emerging markets, our passive manager is doing what we expect, so they're generating the market return or a little bit better. You can see that our quant managers have been doing reasonably well, so less volatile but more sustained performance. Although in emerging markets, you can see that our systematic sleeve there over the last 18 months has really struggled. And that reflects some of the difficulties that quant managers have experienced everywhere. We've seen a high correlation between two of the key factors that they normally invest in, so value and growth. So because there's been less correlation, the alpha they've generated hasn't been as strong as we would normally expect. Then we can look at the dashed line, which is the fully active managers. We can see that they've done very well in terms of their excess return development over time in both the developed markets and in the emerging markets. But in Australia, you can see over the last 18 months or so, they've really struggled. So active management in Australia has had a really tough time over that period. And it reflects a couple of things. It reflects the fact that markets are being driven more by interest rates. It reflects a very narrow market leadership in Australia. So only a small handful of companies are generating excess return in Australia. And that makes it very difficult for active managers to really get the right diversification across their portfolio if they're not exposed to those stocks. And then I think the final point is they're incredibly expensive. Those stocks that are driving the Australian market, so CSL, Afterpay, for example, are incredibly expensive. And our managers think they're overpriced and have tended to underweight them. But as a result of that, their performance has lagged. And in each of the charts, you can see the dark blue line. That's the combined performance of each of our portfolios. And what we're trying to do over time is really produce a very diversified portfolio that generates a little bit of alpha over time. And you can see that's what we've been able to achieve using our approach. So that's the last of the slides I had and the last of my prepared comments.
Thanks, Greg. And there's some pretty comprehensive explanation there, which has actually covered a lot of the questions that I had, and also we've been getting coming in by the live webcast. But perhaps I can ask you one, Greg, and then I might segue over to Ali to ask one of the live questions. What are the advantages of going to of having, say, a passive mandate with Vanguard, as opposed to going via one of the Vanguard funds? Yeah, what's the advantage? Yeah.
It's a good question, Mark. I think there's a number of advantages, but principally one of them is using our scale to achieve a much lower price with Vanguard than you would achieve if you were just investing via their funds. So we were able to drive the cost of the mandate down to very low single-digit basis points. And that's reflecting our style, our scale rather, and the relationship, the size of the relationship we have with Vanguard. We don't pay any spreads, as you might experience in a fund, so there's no buy or sell spread. Our portfolio is really just transacting at the base point. And then we can tailor make those mandates. So as I've mentioned a couple of times during the presentation, we're able to achieve high levels of participation in off-market buybacks, which generate significant upside for our members. And that's something that a passive Vanguard trust, for example, wouldn't do. And then we're also able to ensure that we have various exclusions in that portfolio. So as you know, our portfolios exclude tobacco, they include non-conventional weapons, and they also exclude the worst forms of human slavery. So it's that ability to customise the portfolio that's important. And then we have the benefit of our strategic relationship there as well. So our ability to do pooled research, to use a lot of their engagement capabilities and so on. So there's a wide range of advantages we have through that direct relationship with Vanguard as opposed to using their ETFs or trusts.
Thanks, Greg. A good comprehensive answer. What I'll do now is pass over to Alessandra. We might, given the time, be able to squeeze in a couple of our live webcast questions. Ali, so would you like to pitch a couple of those to Greg, please?
Yeah, sure, no problems. Greg, we've got a questions about changes in our managers. Have there been any recent changes, and generally how often do we change our managers?
Yeah, Ali, we really try and minimise turnover in our portfolio because of the effort and the work we go through to identify the best managers globally, to negotiate with them, and then the process of actually setting up the segregated mandate and all the plumbing that goes in place. We really try and avoid changing our managers wherever possible. Obviously, if there are issues with a manager, then we'll look at that. So things like changes in their business model, key team members leaving, and then sustained underperformance. But typically over a longer term, 3 years or so is the period that we would look at. And as I said, we have relationships with managers that have lasted many years. So Maple Brown Abbott is several decades. The same with Tribeca, another small cap manager here in Australia, a multi-decade relationship. So we really try and have a small number of managers, but long-term relationships. Having said that, here in Australia, last year we terminated a manager where they had significantly changed their business model and had moved away from a focus on institutional asset management, which is what we are and what we value, to a much more retail-oriented model. And we felt that really compromised their business. So we terminated that manager. And given the research that we do and the ability for us to have a strong bench of managers ready to use at any moment in time, we're able to very quickly move that money from one manager to a new manager. So that was a lesson learned for us, our ability to have a strong bench and our ability to move very quickly in terms of transitioning from one manager. Because we have individual mandates, we can make changes very quickly, literally within a couple of days. So we can move very quickly as a result of that. Then occasionally we'll need to change managers based on portfolio construction needs. So a couple of years back, we had a manager that was in our systematic sleeve, so a quant manager, and we felt that the style was something that we didn't need. They used a long-short model. It was expensive. It really didn't fit within our portfolio construction. So we, again, removed that manager and appointed a new manager, or actually was able to take that funding and move it into an existing manager.
Cool. Ali, second question?
Yeah, sure. On a scale of cheap to expensive, how are equity markets valued at the minute? Easy.
Look, they look expensive all around the world on average, but I think they're certainly getting up to, I would say maybe an 8, a 7 or an 8 if I had to make that judgment. But, we live in a relative world. So our managers are always looking at, what is relatively expensive and what is relatively cheap. We're trying to avoid what is relatively expensive and invest in what is relatively cheap, believing that over time, relatively expensive will come down and relatively cheap will go up. And we see that in the stocks our managers are buying. We see it in our portfolio exposures. So, we're underweight tech in a lot of countries, but we're overweight some of the more attractively valued sectors. We're underweight US, for example. So I think, it's that relative mix that we focus on. But you know, at an absolute level, yeah, it looks like an expensive world, but there are reasons for that.
Excellent. Thanks, Greg. And look, time is not our friend and ticks on, but maybe in terms of a concluding comment, Greg, could I maybe get you to give a little bit of a pitch to our advisor audience? Why would they recommend our listed portfolio to their clients?
Yeah, thanks, Mark. I think, first of all, you know, our approach really provides access to some of the best managers globally. As I said, we spend our days trying to identify the best managers we can around the world. It doesn't matter where they're based, we seek them out, and we have a very structured process to identify those managers, engage with them, build relationships, and ultimately bring them into the portfolio. So we're not a small team internally trying to manage stocks. We think that using an external model allows us to access the best managers and build very diversified portfolios. So I think that's a key differentiator. That's a key point of importance. I think we build a very diversified portfolio. So as I said before, we think about building a very broadly based portfolio that doesn't have a concentrated exposure to one particular country, one particular style, one particular sector, one particular risk. So we build a portfolio that's very well diversified. Of course, we want to add a little bit of alpha through that process, but we don't want to spend a huge amount of money to do that, and we don't want to bet the farm to generate that alpha. We think that having a strong focus on risk really helps us to construct very robust portfolios that can scale and grow with us going forward. So, you know, I think about that as providing great value for money. I think that, you know, that's a key differentiator for us. I think also, you know, Sunsuper's culture is very much member focused, member first. You know, we really strive to do the best thing for our members. And in listed shares, we think about that in terms of making sure that there's full alignment between our managers and our members. So how do we do that? We have fee structures that ensure that, you know, if a manager is doing well, we reward them. If they're not doing well, we don't reward them. We have very low base fees to ensure that we get good value for money, that the lights are kept on, that they're able to employ good people, but we're only going to pay them if they perform well. And then importantly, here in Australia, we've moved to a full after-tax performance benchmark. So that means that all of our managers now are aligned with member outcomes because members get after-tax returns. So having all of our members, all of our managers rather, on after-tax performance benchmarks means that they think about generating after-tax outcomes because that's how they get rewarded. And it's those very same after-tax outcomes, those after-tax returns that go to our members. So I think that's also an important differentiator for Sunsuper and something that as an advisor or somebody that's using Sunsuper products, I think that's an important differentiator as well.
Excellent. Thanks, Greg. Very comprehensive answer. And thank you also for your presentation and your answers today. Ladies and gentlemen, time has come, so I'd like to thank all of our listeners for dialing in today and also if you've dialed in for the broadcast in the past. A couple of references. If you go to our website, we've got a COVID site which has a whole lot of resource material for the crisis. And secondly, the previous webcasts, which obviously focused on our unlisted assets, are available at the Advisor Webcast tab there. What can you expect from today? You'll receive a copy of this recording along with a survey for your CPD points. We'll also follow that up with another survey just to see whether this particular series of webcasts hit the spot and how we can improve any future ones or other events. Ladies and gentlemen, thank you for joining us for the series. We hope you got some value out of it and I trust you enjoyed the rest of your day. Thank you.